This is a lecture from Open Tuition. For the free lecture notes that go with this podcast, please visit opentuition.com. In the previous lecture on interest rate risk management, I explained what it is we're looking at, what the risk is that we're talking about. The risk that it's fixed interest borrowing, but the risk that the interest rate may change between now and the date the loan actually starts. And I said there were 4 ways you're expected to be able to deal with in terms of managing this risk. And let's look at the first of the 4, something called a forward rate agreement. And here it's very simple indeed, in that if we know we're going to need a loan in, let's say, 2 months' time, and we want fixed interest, then instead of just waiting 2 months and then finding out what the rate is, we can simply go to the bank, tell them that we're going to want to borrow money in 2 months' time, and they'll quote a rate now to apply to that loan starting in the future. So a forward rate, it's an interest rate quoted now, an interest rate quoted now to apply to a loan starting on a future date. And let me show you what I mean with hopefully a very easy example. If you look at example 1, on page, page 116. It says it's now the 1st of June, so today is the 1st of June. XPLC will need a fixed interest rate loan of £500,000 for 9 months, starting on the 1st of September. Now, before we read any more, with a forward rate agreement, you simply go to the bank, you tell them how much you want to borrow, you tell them they'll need to know obviously for how long you want to borrow it, and you tell them when the loan's going to start, and you ask them to quote a rate. And the bank, it says, has quoted a rate of 10%. Well, the first bit is just pure terminology. When we ask the bank, they're obviously going to need to know how much we're borrowing and for what period and what day the loan will start. And the way we ask them, we tell them the amount. So what is it here? It's 500,000. We tell them we want a forward rate agreement, and the abbreviation we call it an FRA. So we want a 500,000 FRA. And they'll need to know when the loan's going to start. Well, today is the 1st of June. We want it to start on the 1st of September. Well, how many months from now is it? June, July, August. It's in 3 months. So the way we tell them the start date and how long it's for, we say we want an FRA 3. That's the start month. We want to borrow the money for 9 months, so surely we want the loan to start in 3 months' time, 1st of September, and if it's going to last for 9 months, we want it to finish in 12 months' time. And so that's what we ask for, an FRA 3 to 12 on £500,000. And the bank will quote a rate. And of course, the bank can quote any rate they want. They'll be taking into account what they think is going to happen to interest rates and so on. They quote a rate. It says in this question that the bank quotes... I do keep having problems with this. The bank quotes, what does it say, 10%? Note, it's a yearly rate in the exam. Interest rates will always be yearly rates, and so we won't actually pay 10%. We'll only be paying it for 9 months. We'll do the arithmetic in a moment. But as I've said, the bank can quote any rate they like. And it's really our choice. If we're not happy with the rate, try a different bank, see if we can get a lower rate, or perhaps not even bother doing this. But that clearly is our choice. However, that's part A, what FRA is required, and that's just terminology. Assuming, though, that we do accept the FRA, then this loan starting in 3 months, we will pay fixed interest at 10% a year, whatever the actual interest rate turns out to be. However, and to be honest, less important, but just in case it's relevant in the exam, the way it actually works is just not strange, but not quite what you might expect. It says here in part B, calculate the result of the FRA and the effective interest rate if the actual interest rate on the 1st of September is 13%. So remember, as of today, we've got this FRA. No money's changed hands. All we've done is, if you like, sign the agreement. But that happened today, now, 1st of June. We've signed the agreement, and we then wait until the 1st of September when we're actually going to take the loan. And it turns out, in part 1, that on the 1st of September, for new loans, the bank at that stage is quoting 13%, but of course, we've agreed with them a fixed rate of 10%. Well, the way it actually works is, although we will end up paying this fixed rate of 10%, it's almost as though you've got two departments in the bank. On the loan itself, we pay the actual interest rate. And so that when we negotiate, when we actually take the loan, it's $500,000. The actual interest rate that they're charging on the 1st of September is 13%. But of course, that was a yearly rate. We're only going to be borrowing for 9 months. So it'll be 9/12. So the interest chargeable on the loan for the moment will be, I think, 48,750. We're borrowing money. We're obviously therefore paying interest. However, the bank had promised us, we'd agreed a fixed rate of 10%. And so, separately, the bank then gives us back the difference. The FRA comes into play, and they'll say, okay, you've got an FRA on $500,000. So far, we're charging you 13%, but we'd agreed a fixed rate of 10%. You'll get back the difference of 3%. But again, of course, since it's for 9 months, it'll only be 9/12. And so they'll give us back 3% on 500,000 for 9 months, which is 11,250. That's a receipt. And so the net result, of course, we pay on the one hand 48, we get back 11. The net result is 37,500. And I'm sure it's already obvious the net effect is 10%. However obvious this may be, just something to get in the habit of because of later exercises on futures options where it's perhaps going to be less obvious. If you were asked what the effective interest rate ended up being, well, however obvious it may be, we've ended up paying a net 37,500 on a loan of $500,000. However, whatever rate that came to, that's over a 9-month period. Well, if you were ever asked an effective interest rate, they'd want the annual rate, and so to gross it up to 12 months. If that's for 9 months, multiply it by 12/9. And what does it come to? It comes to, of course, 10%. So we do end up paying 10%. And I've said to actually show it arithmetic, to be honest, is not that likely. But just in case, do see it really is two separate bits. It's almost as though you have two departments in the bank, or even two banks involved, to be honest. But one department which is actually lending the money, they charge whatever the rate is. The other department, the FRA department, where they've given you the guarantee, and if the rate's too high, they pay you back. One small point, I'd be silly not to mention it, is although the net cost is $3,500, the interest on the loan, usually, you pay the interest at the end of the loan. That's not a rule, it depends obviously on the agreement, but normally you would expect to be paying the interest at the end of the loan when you repay the money. The FRA, though, usually that will be settled up at the start of the loan. Because, of course, given it's fixed interest borrowing, on the day the loan starts, we know for certain then what the actual interest rate is, 13%. We obviously know the rate we've agreed, 10%. And so it's usually at the start. And, of course, that timing difference does actually affect things. It's actually, in this case, to our benefit. For the exam, that would certainly be irrelevant, apart, if you got the chance, apart from mentioning it. Just to finish, though, here, remember we'd gone for an FRA at 10%. In part 1, the actual interest rate turned out to be higher, and so we got back the difference. But equally, if the rate turned out to be lower, well, we have agreed at 10%, we'll have to pay in the difference. So what I mean is, you see in part 2, where the actual interest rate is 8%, on the loan itself, you pay the actual rate. 500,000, 8%, 9 months. And so the actual loan interest would be 30,000. However, we'd agreed a fixed rate of 10%. And so again, the FRA would come into play, but this time we'd have to pay on the FRA the extra 2% to get to the 10% we'd agreed. And so on the FRA, we'll have to pay in 500,000. The difference, the extra 2%, again for 9 months, which is 7,500. And of course, the total, and I'm sure you can see whatever happens for any interest rate, the total will end up 37,500, which, I've no need to repeat the arithmetic, it is an effective rate of 10% per annum. So with an FRA, you would end up always paying this fixed rate, which for this example is 10%. So, I hope you agree, very easy from a practical point of view. Go to the bank, agree the fixed rate, and equally easy in the exam. But certainly, you could be required, if nothing else, to mention it. Well, because that was an easy one, let's do the second one as well, which is equally straightforward, something called an interest rate guarantee, or an IRG. And what this is, well, when we did a forward rate, here, we'd fix the rate at 10%, and whatever happened, we had to pay 10%. And so obviously, if interest rates go up, we'll be rather glad we'd got the FRA, as in part 1. But equally, if interest rates go down, well, we don't benefit from the fall, because we had to pay in the extra. We don't lose, but equally we can't gain. Well, it could, of course, be that we are pretty certain interest rates are going to go down. And so we don't want an FRA, the more it goes down, let's take advantage of it. But it would be dangerous to run the risk that we might be wrong and interest rates go up. And so the alternative of these two, instead of completely fixing the rate, is to get the bank to agree a maximum rate. And so an interest rate guarantee, it's where we fix a maximum interest rate. To apply to the loan. Incidentally, I'm talking again about borrowing. In the exam, almost certainly it'll be borrowing money. Exactly the same sorts of thing could apply if you're depositing money, though. If you're depositing, when you're receiving interest, you could have a forward rate agreement and fix the rate of interest. Or you can have an IRG. But of course, with an IRG, instead, if you're depositing, instead of fixing a maximum rate of interest, surely you'd want to fix a minimum rate. However, we'll deal with borrowing, and to show how it works, look at example 2, please. On page 117. It's now the 1st of August, and Y plc will need a fixed interest rate loan of 200,000 for 6 months, starting on the 1st of December. And we've asked the bank for an IRG at 12%. Well, two things here. First of all, purely on terminology, when you go to the bank, clearly they'll want to know how much you want to borrow. 200,000. We want an interest rate guarantee, an IRG. They'll want to know the time period. Well, we quote it in the same way as we do an FRA. So we want the loan to start on 1st of December. It's now 1st of August. So the start month, August, September, October, November, December. We want it to start in 4 months' time. It's going to last 6 months. It'll finish in 10 months' time. But this time, we tell them what the maximum rate we want is. We tell them we want an IRG, and it says we want at 12%. So we're telling the bank that's the maximum rate we want. Fine, the bank will agree to let us have a maximum interest rate to fix a limit. But because, again, we can only gain, we can't lose, they'll charge a premium. And so the bank charges a premium. They can charge whatever they like. It says here the bank's quoted a premium of 1,500. But as I say, they can charge whatever they like. If we don't like it, go to a different bank, see if they're any cheaper. But there will be a premium payable. It's payable immediately. Whether or not we take advantage of this limit, of this maximum rate. Well, fine. 1st of August, we've bought the interest rate guarantee. We then wait until the date the loan starts. So the loan starts here on the 1st of December. And it's on that date we find out the actual rate that's being quoted. But of course, we're guaranteed that it won't be more than 12. Well, it says calculate the result of the IRG and effective interest rate. If the actual rate on the 1st of December is A, 13%. Well, the way it works, on the loan itself, we pay the actual rate. It was 200,000. The actual rate is 13%, but of course we're only borrowing for 6 months. And so the interest we'll have to pay stupid of me. 200,000. I don't really need a calculator, but something. 13,000. However, we have this guarantee that it wouldn't be more than 12%. And so, similar workings to the FRA. Since it is more than 12%, we'll effectively claim on the IRG, and we'll get back that extra 1%. The IRG was on 200,000. We've been charged 13, but we were limited to 12, half a year. And so we'll get back, what is it, 1,000, I think? It's a bit embarrassing. 1% for half a year, yeah, we'll get back 1,000. And so the net payment ends up being 12,000. But don't forget, we'd have to pay that premium. The bank had charged us 1,500. And so in total, it's ended up costing us 13,500. And so what interest rate have we ended up paying overall? The effective interest. We've paid 13,500 on a loan of 200,000. However, that's only over a 6-month period. So to gross it up to a yearly rate, 12 over 6, it means the effective interest rate it's in fact 13.5%. And you can see what's happened. You see, although the IRG itself was limiting us to 12% interest, the fact we've had to pay another 1,500 has meant that in total we've ended up paying 13.5. But that is the worst possible outcome. But you see, for every percent the interest rate is above 12%. I'm not going to redo, obviously, but if the actual interest turned out to be 14%, 15%, we get more and more back on the IRG. So the net result, the worst that could ever happen, is we pay a total of 13,500 or 13.5%. But of course the benefit to us is if interest rates fall. So part B says, what if the actual interest is 8%? Well, on the loan itself, you always pay the actual rate. It's 200,000, 8%, half a year, which is 8,000. But the IRG, all it did was limit the maximum rate. Here it's below 12%, and so the IRG itself becomes irrelevant, except, of course, whether we end up taking advantage of the IRG or not, there was always the premium payable. And so, in fact, we end up paying 9,500. And the effective interest we've paid 9,500 on a loan of 200,000. It was for a 6-month period. Gross it up to a year, and we've ended up paying, well, 9.5%. So, although you're always paying that extra premium, the beauty of an IRG is that, of course, if interest rates fall, as perhaps as I expect, we're getting the benefit of that fall. But if we're wrong and interest rates go up, then at least we've limited the maximum. It's an interest rate guarantee. Effectively, I'm sure you'd accept from what we did on currency, foreign exchange risk, that effectively it's an interest rate option. In a sense, it's our choice whether to exercise the guarantee, the option, or not. If rates go up, we exercise it. If rates go down, we don't. Or, the other name for it, we call it an interest rate cap. If ever you see the words interest rate cap, it's where you fixed a maximum rate. The reason, in a sense, people wear a cap on their head, and if you've got a cap on your head, it stops your head getting any higher. Well, an interest rate cap of 12% means you're never having to pay more than 12%. While I'm on it, one other bit of terminology. I think you'd agree, certainly if you're borrowing money, that's what you'd be interested in, to limit the maximum rate. But equally, if you were depositing money and you're worried that interest rates may end up falling and you'll receive less interest, surely if you were depositing money, you'd want to fix a minimum rate. You're receiving interest. If interest rates go up, great, get the benefit. But if interest rates fell, it'd be in your interest to fix a minimum. Well, if you're fixing a minimum, and it'd be the same sort of workings we've just done, we then call it an interest rate floor. So irrelevant for the numbers, but just in case the words are mentioned, a floor is when you've fixed a minimum, because again, the floor is what stops your feet getting any lower. There we are. All right, those are the two relatively easy ones, and it took me a while to explain. They're not likely to be any more than a few marks in the exam. Where the real work comes is on futures and options, but we'll deal with them next.